What's up, everyone? Welcome to another episode of Finance Simplified, the official podcast for Street Fins. We're here to break down the world of finance for you to understand from a relatable perspective with discussions with experts. My name is Rohan, and this is episode 34. I'm joined today by my co-host, Alex. How have you been since our last episode?
I've been doing well. I've really been enjoying my internship, and I'm loving New York City.
That's awesome to hear. So Alex, this is part 2 of our conversation with the head of Princeton University's endowment, Andrew Golden, on the topic of simplifying university endowments. What did we talk about in part 1?
In part 1, we covered Andrew's background, as well as the basics and history of endowments.
We'll be getting more into diversification, the rules surrounding endowments, careers at endowments, and much more in this episode. Additionally, we just want to remind you that if you are learning from our episodes and want to keep supporting what we're doing, we'd be eternally grateful if you gave us a 5-star rating and review on Apple Podcasts. Even if you're listening to this on another platform, as long as you have an Apple account or device, you can support us with the rating. If you're tuning in on Spotify, we've posted some questions with this episode that you should see on Spotify that we'd love for you to answer, as it'll help us improve our episodes. We'd also love to know what feedback you have for us, so get in touch with us to let us know how we're doing and what you'd like to see from us going forward. Also, stay tuned till the very end of our episode because we'll be teasing our next episode's guest. The first person to send us an email with the correct guess will get a shout out. Now, let's continue simplifying university endowments. Welcome to Finance Simplified, the official podcast for Street Fins created by students that simplifies the seemingly complex
and confusing
world of money. We're your hosts, Rohan
and Alex.
Yeah, that was a very thorough kind of explanation of at least your view on what David kind of brought to the endowment space. And, you're talking about like distressed securities and investing in not just in the typical stocks and bonds that typically comprise maybe an individual's retirement portfolio. And by extension, I guess what was predominantly the university's way of thinking about endowments, which is not looking into alternative spaces like distressed securities or short selling and finding managers to back those. So very interesting. I'm very curious, David in his book and a lot of his philosophies, he talked about the importance of diversification. And, he was using not just stocks and bonds, but also these alternative assets to do that when he was trying to essentially revolutionize the endowment space. My question is, how exactly do you, and I guess maybe university endowments, just approach diversification? Is it just as simple an idea of finding uncorrelated assets, or is there more to the process that you've discovered throughout your career working with David and on your own?
I think among several of us, there's been some evolution in thinking. So when Dave was writing the book, I think what he thought about diversification was in the kind of classic sense of don't put all your eggs in one basket. And that's still true. We can think of diversification as a risk mitigant. But it's also the case that it broadens your opportunity set. And, I think where many of us have gone is it's less about a top-down model of here's the exact right allocation of a portfolio, and it's more bottom up of where do you think you have an edge, and does that edge translate into an unfair amount of compensation for that risk, for overcompensation for the risk that you're taking. And it's kind of mathematical that if you have deserved confidence in your ability to select among things, all other things being equal, you should have somewhat less diversification. If I were a divine being and I knew exactly what the best investment was, it would be silly for me to do anything other than that. So, if you actually had that kind of analytic perfection, right, then any amount of diversification would be what Peter Lynch would call de-worsification, that you're diluting. So I think a lot of us have moved to somewhat more concentrated positions. And one of the things that we strive at Princeton is to really think of the portfolio of the organization, one team, one dream, and that allows us to actually have a surprising amount of concentration within individual buckets. So I may not be answering your question. How did he think about diversification? He thought about, let's explore all different kinds of arenas and see if they make sense for us to participate. And just because others have not done a lot of that before, then maybe we, Yale and other schools, can do a lot of it because maybe it makes sense for us.
Yeah, and I read on one of Princeton's, press releases that was regarding the endowment that you had taken, I think the quote was an aggressive equity biased approach. So it was kind of speaking to like the bias, the concentration that I guess you and maybe some other fund managers or endowment managers are focused on. My next question is, the endowments have obviously grown incredibly. The size I think has more than tripled since 2005. I may be wrong, but the idea is, endowments have grown. Are you finding it harder with a growing essentially AUM? Are you finding it harder to earn returns on that? What's sort of this relationship between scaling an endowment and the returns that you're able to get? Is it the same as, I guess, the traditional thinking that the bigger you get, the harder it is to earn returns, or is there something that is a little different?
Look, the math and the physics, they are what they are. There is a vector, there is a force that says all other things being equal, it's harder to make the same returns on 50 billion as it is on 10 billion. Now, it's also hard to make the same returns on 500 million as it is on 10 billion. There's that kind of, you need a certain critical mass to be able to support, the work that is involved in finding things off the beaten path, and to be able to invest in a scale that actually enables you to be a great partner. Being a great partner means, it's necessary to be both smart, but it's also helpful to be rich enough that you can help managers execute fully on their opportunity set. So one of the things that I truly love about my job is the intellectual challenge. And it's not like we're waking up to this notion that as we got successful, our assets would get bigger and all other things being equal, it would get harder. Anyone who's a first principle thinker would realize that that was a vector we had to deal with. So the beauty part is designing a system where you can keep delaying or keep pushing up the ceiling of, can you keep investing the way you've been investing with the same success? Delaying when you hit that, oh my God, our assets are so big, we're going to have to accept diminished returns. And so in our case, that's a little bit about, ironically, the concentration that we worked hard to, we strive to be the best partner each of our partners have. And so we can represent a surprisingly large share of the assets of these frontline experts. And because we're a large share, that as they grow, we also get to grow in meaningful ways with them. And that means that we can deploy more money. So like right now, it certainly could handle at least 50% more of the assets than we have right now without getting too concerned. And then we're striving is to kind of keep building up a system that we can keep moving that out. At Princeton, we like to use the phrase, we need to think and invest with a horizon that's beyond the long term, that our program, our organization, 10 years from now, will have the same odds of success as we have today.
Yeah. Are there other sort of important factors that you look at when investing the endowment's money? I mean, we've already talked about the sources of the investments, how you guys diversify, but is there anything else that you consider when trying to invest the university's money?
Well, look, I've actually made a career taking credit for other people's work, whether they're people on the staff here or our investment partners out, in those front lines in these various arenas, our partner firm. One response to your question is, what do you look for when you're choosing those partners? And I think very important is an alignment of appetites. There's no contract that we can construct that will guarantee that people behave exactly as we would want them to in all circumstances. So we spend a lot of time thinking about what the motivations are of folks. And, the ones who we want to partner with are those who have good moral compass, that they kind of know that there's some things that just shouldn't be done, even if they make money. But importantly, their objective is to produce the best possible returns. Their ego is motivated that they're going to prove themselves to be great by the success that they provide for their partners. In the investment world, it's subject to the constraint that people also want to make themselves silly rich. Right? So we're looking for people who want to do the best they can for us, subject to making themselves silly rich, as opposed to the vast majority of money management industry, is in it to make as much money as they can for themselves, subject to producing good enough returns for their partners. So that kind of alignment of generally thinking the same is a fair way here. We're not going to agree on everything. That's important. I think one of the evolutions in our industry that's long overdue, that's super important, is we are great believers in the power of teams. That's always been true. But we're kind of better understand now that all teams that are trying to deal with very complicated issues, like is involved in investing, that you want a lot of diversity of thought around the table there. And diversity of thought tends to correlate with some other measures of diversity. So I think, the Princeton today is very interested in broadening our access or deepening our access to a much broader talent pool than was ever the case before. And, I think it's like a taste great, less filling. It's nice because that's a good thing for society, but it's also motivated because we're going to make a lot more money if we can attract the best talent and put them together, or at least amalgamate something that, we may not be the ones putting it together, but create a roster that, comprises a lot of different ways of thinking and a lot of different backgrounds and a lot of different experiences.
Yeah, certainly. That's a fantastic explanation of sort of the talent side of the endowment space. I kind of want to delve into maybe endowment rules and sort of to start off, could you describe what kinds of autonomy an endowment has, and how does maybe withdrawing money from the endowment actually work? How are assets liquidated?
Right. Well, let me deal with the second one first. The different endowments have different spending frameworks, and they're all trying to wrestling with, I mentioned the mission to spend as much as possible, but there are these two constraints of preserving purchasing power, but also having reasonably steady spending. And that steady spending is important because you can't yank the budget around. And it's also important because to do the kind of long-term planning that an institution whose entire world is meant to focus on the long term, you need some predictability. So the spending rates at Princeton are set with a framework that kind of guides people to spend a bit more each year than they spent the year before, subject to that falling with a band of spending rates. So define terms. The spending rate is how much is spent divided by the market value, starting market value of a unit. And we try and guide that between 4 and 6.25%. And the little bit more is what we call an inflator, that if last year we spent $1 per unit, then this year we're going to start out with a presumption that we'll spend $1.04. And that's meant to kind of be somewhat tied to inflation and maybe, a little bit more. So what I've been using this term unit. Endowments themselves and the kind of accounting within it tends to be very similar to a mutual fund. When someone makes a gift, it creates these shares, and then the spending is calculated on that kind of per share, per unit basis. So that spending, we've got a pretty good sense of that looking out. And as we design an investment program, we want to make sure there's sufficient liquidity to pay those bills. In terms of the autonomy of the investment decision making, we've evolved at Princeton to a lot of authority being given to the staff. We've got trigger pulling authority operating within very broad guidelines that we can direct a lot of money just based upon our own thinking, so that we can react fairly quickly, and importantly, that we can react in ways where it kind of maximizes our ability to be unconventional, because the folks who are kind of in the weeds all the time develop a deeper understanding of it than something that just kind of looks good in the memo to a investment committee that is just kind of coming in and out. So we're blessed to have that kind of authority, and it does mean that we can move some pretty significant amounts of money very, very quickly. And so we know that there are known things coming up, like the need to spend to the university, and we know that there are known unknowns, as they say. We're not exactly sure, but we operate with contracts with our managers that give them the right to call up and not just ask, but demand that we fulfill our contract and give them money to invest. And then there are kind of surprises, some of which are pleasant. Oh, here's an opportunity to do a great investment that we never thought about that would be available. And sometimes they're unpleasant, like, oh, all those managers are calling up money at the same time. So we better make sure we have enough kind of liquidity reserves to fund those calls.
Yeah, that's a really great kind of overview of some of the rules. I'm going to transition into careers and endowments, given that you've had such an unconventional one. You probably have seen a lot of people come in through both the conventional and unconventional roles as well, some of the staff that you've been working with. So supposing some of our listeners want to pursue a career in the endowment space, how would you suggest that they prepare for maybe that entry-level job, or maybe trying to plan a career in investing with endowments?
Yeah, well, look, I may be talking my own book, but I would really discourage people from spending a lot of time, particularly if they're young, particularly if you're in college, in this kind of pre-professional mindset. I think you want to learn how to think. I think you want to learn how to communicate. You want to learn how to work with teams. And all those things will be easier if you're really loving what you're doing, as opposed to acquiring a particular toolkit. So, to outperform, you have to be both different from the consensus and right. And if you focus too much on that toolkit acquisition and not enough in kind of finding your own voice, your own way of framing things, it's going to be really hard to think differently. It's going to be really hard to succeed, think differently. If you want a career in endowment management, you want a career as an allocator as opposed to a frontline investor, and I think it's great, then you need to know a lot more than modern portfolio theory, than how various equations work. I think I had an unfair advantage coming to my career the way I did. Part of that was that when I ultimately got involved in endowment management, I thought of myself as Andy, who happens now to be doing endowment management, as opposed to, oh, I'm an investor. And because I didn't think of myself in the first as an investor, then I was much more willing to fail at it because it was just something I was doing. It wasn't who I was. Now, again, as an allocator, our job is as much about evaluating organizations as they are about evaluating investments. Right? In fact, the understanding of investments is really in service of our ability to be able to understand how people are thinking about investments and how people are thinking about their organization. So one of the 4 reasons why I love my job is that intellectual challenge of it's not just about investing, it's about people, and it's about organizations. And what's great is we get to seek truth in doing it. So that kind of leads into the second reason, which is we're given all the tools that we need to compete hard to be the best at what we do. And the third is that kind of mission reward. And the fourth is I get to work with great people. Now, the idea of a specific toolkit at best covers just part of one of those 4 things. So I'm avoid now the cliche of follow your passion. I don't like that phrase because it presumes that people know what their passion is, and that it sounds like you should know who you want to marry before you even date, right? It's like, no, just follow your like. And so particularly in undergrad, I would just pursue anything that you think is going to help you learn how to think, and anything that's going to teach you maybe how to communicate and work well in teams more than anything else. And like working in a restaurant really helps you understand how business works. Right? So people should be doing more of that and less worried about their kind of prestigious internship.
Yeah, that's a point really well taken. I think it's applicable to, really every career. I think, within endowments, it's not just about investing. It's about getting those other skills and other frameworks through viewing your career and your future. So really well taken in probably by our audience as well. I kind of want to move on to the future of endowments, and specifically with regards to the Princeton endowment. Last year was kind of a remarkable year for, I think, every endowment, particularly Princeton. I think it was almost 47% returns. It's understandable given how the market did perform, and especially given kind of your equity-heavy portfolio. But, what do you think is the future of the Princeton endowment? Do you see any huge paradigm shifts? Do you see any changes that you're going to make in the near or long-term future?
Well, yes and no. So the way we have always thought about investing goes back to how I described the endowment model, is tailor the program to your distinctive circumstances as an investor. The right portfolio for Princeton is very different than the right portfolio for an 80-year-old, retiree. Right. So, focus on that. And then once you have a base level understanding, then possibly in certain circumstances, you want to, at the margin, shift away from that. Right. But the beauty part about having a long-term plan is that it allows you to default to a position when you don't have, in part because you shouldn't have a strong view as to what to do. There's an old joke that the most dangerous words in investing are, it's different this time. I think the most powerful words in investing are, I don't know. And so more often than not, we're guiding that portfolio to that basic plan. Right now is one of those once every many years where we say, wow, the world looks really odd. There's amazing amounts of overvaluation in most markets. And so right now, it feels okay to get a bit more defensive. And so that's a little bit different in reaction to the conditions that produce that 47% return. So that will be different over the short term. Over the long term, I think we've cracked the code on how to create a program that's suitable for our mission, which is, make sure you're focusing on the right horizons, exploit your advantages, compete where you have an unfair advantage and don't where you don't, and depend upon the great partners. And part of what makes a successful endowment manager is having the right ego, right? Like it's kind of like being the coach and not the quarterback. Right? So people maybe want to be the quarterback, be in the front lines, or you're saying, well, you look at some consistent great programs. The coach was really pretty important to that. And I think we've got the right playbook, if you will, for that. But we're just at the margin to tweak it a little bit.
That's great. And I appreciate the football analogy before the Super Bowl this weekend. And so now we're at our final question. So this is a podcast that's obviously made by students for other students, but we really broaden it out to anybody who's young and wants to learn about the field of finance. So our final question is this. With all our guests with children or who have some kind of involvement with a university or students in general, given your career having gone through everything that you've gone through, what lessons have you given to your children and maybe other Princeton students about the world of money? What do you recommend for other students today?
Right. Well, the first thing is it's only money, right? So you got to be careful as to what is drawing you to the area, right? Do you really enjoy the activity involved in investing, or is it something else that's going on? And it's important because for a lot of folks, they're drawn to it because there's like a scorecard aspect of it. Now, unlike being a doctor, there's a number that you produce each year that tells you how well you did versus other folks. And I think you got to be careful and just keep perspective on that. I think it's important to understand how much luck is involved. Even in a 27-year track record, there's a lot of luck. Our job is about trying to position ourselves to have more good luck than bad luck, right? But there's still luck. And so the world of money, I think you got to have that perspective. And then it gets back to, for most things involved in investing, with the likely exception of certain venture capital approaches, for most things, the key to success is being contrarian. And, again, that to be contrarian, you've got to have an independent way of thinking. And you'll have that independent way of thinking is if you can kind of try to make sure that you recognize that this money thing is just one aspect of life. And, when you do that, it may help you in another really important element of life, which is to avoid what's known as resulting. We always try and separate the difference between good and bad decisions and good and bad results, right? It's quite possible that you make a very good decision that has a bad result, and you should learn the right thing from that, not the wrong thing. The wrong thing would be it was a bad decision. Right thing is you took a calculated risk and, the dice didn't come up the way that you were hoping. And so that is almost easier to talk about. It's almost potentially easier to talk about investing in other things because it's easier to describe the rules of the game. But it's psychologically a lot harder because if you do a bad decision, but you make a lot of money, it's money. And then you get to enjoy all these things. And so therefore, you must have been really smart. It must have been a great decision. That's very important to try and fight that. And I don't want to give anyone the impression that I've succeeded in never succumbing to this issue. I'm human too. And the decisions that work out well always seem like, oh, those were the better ones I made. They weren't.
Well, that's a great piece of advice to finally give. And with that, we want to thank you for being a guest on this podcast. It was a great conversation, and we look forward to having you on in the future.
My pleasure.
Hey everyone, that was the end of part 2 of our 2-part interview with Andrew Golden on simplifying university endowments. We hope you enjoyed and learned more about university endowments from him. The entire conversation was amazing. Alex, what were some of the key takeaways from this second part?
I thought it was interesting to hear Golden explain that there are actually elements of portfolio concentration in what he does. Blind adherence to diversification may not actually be the best strategy. If there's a good opportunity, take it and invest more.
I think another key takeaway is that the endowment style of investing differs from traditional investing because endowments select managers and task them with the direct investments. This requires more analysis of managers where factors like alignment of interest and moral compasses are of utmost importance. It's a process emphasizing understanding and judging whether a manager is an effective investor and could serve as a key partner for years to come.
Moreover, I really liked his advice on careers and endowments. While it's useful to have skills in modeling and math, the most important thing someone early on in their investment career can do is develop their own voice and view on the world and take up opportunities that can help them do that.
Agreed. Well, Alex, that wraps up our part 2 conversation and takeaways. And now it's time for us to tease the next episode's guest. Remember, the first person who sends us an email with the correct guess will get a shout out in the next episode. So here are the 2 hints for our next guest. Number 1, he's the co-founder of one of the most well-known sustainable investment firms in the world. And number 2, he's the former CEO of Goldman Sachs Asset Management. The next episode will drop in August, so we'll talk to you all then. Hey guys, I want to thank you so much for listening to this episode of the podcast. It truly means the world to us. If you like this episode and others, let us know by subscribing and giving us 5 stars on Apple Podcasts and following us on Spotify. Share us with your friends and check us out on Instagram and Twitter, both at StreetFins. You can also follow me on Twitter at Rohan Invest. If you'd like to get in touch with us, please email fspodcast@streetfins.com. Thanks once again to Andrew Golden for his insights today. I hope you understand the topic of university endowments in a more simplified way. This episode was produced by the incredible Jeffrey Lee. Once again, we're really happy that you're taking the initiative to learn finance and to better your future. If you haven't already, we highly encourage you to check out streetfins.com for articles, videos, and other content. Join the StreetFins community and tell your friends about us so that they can learn about finance too. We'll talk to you next time on Finance Simplified.